Don't touch winners, cut losers. A behavioral and strategic analysis. Most investors do the opposite. They sell winners too early, hold losers too long. But a counterintuitive rule often outperforms emotionally driven behavior. Leave profitable positions alone. Reduce losing ones. Let's examine why this principle works. 1. The disposition effect. Behavioral research by Daniel Kahneman and Amos Tversky demonstrated loss aversion. Losses hurt roughly twice as much as gains feel good. This leads to the disposition effect. Investors sell winners to lock in gains. Investors hold losers to avoid realizing pain. Psychologically, this protects ego. Financially, it often damages performance. 2. Cutting losers controls risk. When an investment thesis weakens or price action signals structural breakdown, risk increases. Capital becomes trapped. Opportunity cost rises. Reducing or exiting losing positions preserves capital, prevents small losses from compounding, protects psychological clarity. Risk control is not pessimism. It is capital preservation. 3. Letting winners run captures asymmetry. In markets, a small number of positions often generate the majority of returns. Long-term investors, like Warren Buffett at Berkshire Hathaway, benefited enormously from holding exceptional businesses for decades. When winners are repeatedly trimmed too early, compounding is interrupted. Asymmetric upside is limited. Large gains require time. 4. Ego versus process. Selling winners feels intelligent. I took profit. Holding losers feels patient. It will recover. But these instincts are often ego-driven. Selling winners validates skill. Holding losers delays admitting error. A rule-based approach removes ego. If thesis intact, hold. If thesis broken, reduce. Process replaces emotion. 5. Opportunity cost matters. Capital tied in a declining asset cannot compound elsewhere. Consumes attention. Increases emotional stress. Reducing losing positions frees both financial and cognitive capital. This improves portfolio efficiency. 6. Trend and momentum evidence. Empirical research in finance shows that assets with positive momentum often continue outperforming in intermediate time frames. Weak assets often continue underperforming. While not guaranteed, this persistence supports letting strength persist. Managing weakness early. The market rewards relative strength more often than emotional attachment. 7. Important nuance. This rule does not mean blindly hold any asset that rises. Automatically sell every short-term loss. Instead, winners should be evaluated based on fundamentals and structure. Losers should be reduced if the underlying thesis deteriorates, not merely because of temporary volatility. Discipline must be systematic, not reactive. Strategic framework. When in profit, reassess thesis, not price. Avoid impulsive profit-taking. Allow compounding to continue. When in loss, reevaluate assumptions. Identify structural versus temporary weakness. Reduce exposure if risk increases. The psychological reversal. The natural instinct. Sell green, hide red. The disciplined approach. Respect strength. Control weakness. One protects feelings. The other protects capital. Final insight. Long-term portfolios grow not because they avoid losses entirely, but because losses are controlled. Gains are allowed to expand. Don't touch winners, cut losers is not just a trading rule. It is a behavioral correction mechanism. And in investing, correcting behavior often matters more than predicting markets.